All right. So everybody can see my screen? Yes, yes, yes. Okay, cool. Access to this webinar is for educational and informational purposes only. Consult a licensed broker or registered investment advisor before placing any trades. All securities and orders are discussed and tracked and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither PhilStockWorld.com, PSW, nor its affiliates, nor any of their respective officers, personnel, representatives, agents, or independent contractors are in such capacities licensed financial advisors, registered investment advisors, or registered broker-dealers. Nothing contained in this webinar, website, or promotional material constitutes promotion, recommendations, solicitation, or offer of any particular investment, security, or transaction. Trading options involves risk. Visit the OCC website, www.optionsclearing.com, to read characteristics and risks of standardized options. PSW provides education and training services are meant to teach you the risks and potential rewards of trading options, and we are not the service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money that you cannot afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on that specific or identified date. Your results may vary. By accessing this webinar, you agree to hold yourself harmless for any losses that you may incur as a result of the information discussed in the media identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously, and we will not distribute or sell your information to anyone. How come casinos don't have to tell you that before you walk in? That would make more sense, right? I think it all applies. All right, what's up for today? Apple partial cover and your view of what Dow's stock does into what Dow's stock? Well, I'm stuck on that Dow. So it does? What does? Let's go for does. Look, I think that obviously Apple went down on essentially rumors that where's my thingies? Oh, I always do that, don't I? Shoot, hang on. Let me find the graph. I don't know I can never remember where they come from. There you go. Okay. So Apple, here was earnings, right? And the rumors were, the earnings were disappointing, but not terrible, and it was going to hold up around 95. But then they started with that BS about iPhone production cuts and blah, blah, blah. So that's when the fear kicked in. We knocked it down to 90. This is where we started buying again because we were excited about that. And, of course, the rumors turned out to be complete crap, and now we're heading back to 100. But that doesn't change the fact they had very disappointing earnings. So into next earnings, they'll have a hard time breaking back to this 105 line, okay? They're going to have to, at this point, between here and here, people have to start thinking about whether or not it's reality. Also, you have this descending channel at 110 that they'll also have trouble getting into. So you're saying what's going to happen for the next 60 days? Well, it would be, obviously it took them 30 days to get back to here. 30 more days gets into 105. They'll probably do it a little sooner, but we'll see. It depends on the market, though. Also, I don't think the market's going to do well, so I don't think, I really don't see Apple getting much above 110. If that, and in fact, frankly, we just sold half the 97.50 calls because I think they'll get rejected at 100. Not through July probably, but I'd rather have the protection than not have the protection. If we're wrong, we're wrong. We could always buy more longs and sell and roll the calls. That's why we're doing a half sale. But meanwhile, the bottom line is we get $1,500 or whatever it was in our pockets, and we can put that money towards rolling the calls to a lower strike if Apple goes lower. If Apple doesn't go lower, we put the money towards buying more longs. Either way, I don't care. And maybe that's like the crux of the question. See, you guys, people ask all the time, is Apple going to do this, is Apple going to do that? I don't care what Apple does. I care that Apple is a long-term hold, so I feel comfortable investing my long-term money in long-term positions, and I feel that I can sell a lot of premium against Apple because everybody thinks they know what it's going to do in the next month or so. So people are willing to bet all over the place. So I see Apple as a wonderful trading vehicle that works extremely well with our concept of being the house and selling risk to other people. So in the short run, I don't really care what they do. Okay, I make my best guess, but I really am looking to mostly just hedge myself out, and no matter what happens, I'm going to collect a pile of cash. And I will use that cash then after I get more information and I see how they do next earnings, then I will deploy my cash. And you guys, I think you got to get with that program because that's the key. It's really, the key is not picking a bunch of stocks. The key is having a system that consistently puts money in your pocket, that consistently gives you wins. Small wins or not. The fact is consistently winning over time will build your portfolio. Even if you're guessing, if you're trying to hit this one and hit that one, even if you do 60%, it's only going to be 10% more of the amount you're gambling over time. But if you consistently win a couple of percent on on your whole portfolio, you'll make much more money. You just don't see it in the short run. It's very, very hard to see in the short run. And I think you guys are all members here. So, but all the PSW members anyway, they know that there's a video called "The Man Who Planted Trees." All right, and I make people watch this over and over again until they get it. The Man Who Planted Trees. See this? It's a free video. It won awards. That thing. Anyway, we're not going to watch it, but I want to just point out, this video is exactly what our long-term philosophy is on trading, okay? It's about just setting yourself up for long-term success patiently and over time. And unfortunately, just like planting trees, though, you're not going to be happy the first few years. Following a conservative wealth-building strategy is not exciting because you spend your first years laying out your positions that are going to make money down the road. And so they're just going to basically lay there and do almost nothing for years until they start sprouting. And then when they get stronger, and when I say stronger, I mean you lower your basis, you increase your holdings by selling consistently the puts and calls in the long term. 2 years out, don't forget, we're selling them. So we sell these puts and calls 2 years out. 2 years from now, they expire, and we lower our basis, right? Our basis is now lower. We do it again 2 years from then, and we lower our basis again. Now, each time we're lowering our basis 10 to 20%. So in three or four cycles, which is 6 to 8 years, we'll have the stock for about half the price that we originally entered it. But technically, you don't have a profit. You just have a lot of stock for a very low price. But then you've got essentially what we call a tree. Then you've got a stock that you purchased a good amount of at a low price that either pays a dividend or we can sell options against and generate a steady income for the rest of our lives. All right? But it takes years to build the position. In fact, that's the funny thing about the long-term portfolio, because the long-term portfolio is full of positions like that, but it's only 2 years old. It's only just getting started. Now, it's doing quite well for 2 years. It's up like 90%, but it's only 2 years old. These positions are not at all mature. They're like little sprouts that are coming up. But when this thing starts cranking, when the long-term well, think about it. The long-term portfolio, where is it? Let me see. Portfolios. See, I know you guys who are newer here, you get excited, okay, 93%. So I know you guys are newer here, and then that's up from Thanksgiving 2013. So all of 14, all of 15, half of 16 are gone. So that's 2.5 years to make 93%. For PSW people, that's not exciting, okay? It's not like, 30-something% a year is not, we're not doing cartwheels though. It's nice, we're happy, it's what we want to make on our long-term conservative positions, but it's not thrilling money. But think about where we're going now, because now we've got $1 million worth of positions. We only started with $500,000 in the first place in this portfolio. We started with $500,000. Now we've got $1 million worth of positions. We're using $1 million worth of margin, okay? And we got about $1 million in cash. So we got about $1 million in margin and $1 million in cash with our $1 million portfolio. So $2 million in buying power. And we keep a lot of cash on hand just in case there's more opportunities that are cool to buy. What do we do though? This is what we do with the bulk of it, with the vast bulk of our investing money. This is what we do with it. We put it into, if AA is below 10, we'll buy it. Okay, and below 10. Below 10 minus 225, we collect it for selling the put. So if it's below 775, we'll buy it. If Anthem is below 110 minus 6, 104, we'll buy it. It's a 130. If BA is below 90 minus 8, so 82, we'll buy it. We're not, you can see already, we're not going to end up buying these things. But if it got cheap, we'd buy it. Now, what are these positions down here? These are ones that did get cheap. They all started out pretty much the same way. For the most part, they started out as short puts. In the course of 2.5 years, these positions, and there's 21 of them, so in 48, 50, so in 50 months there's 21. So every other month, we end up getting a new position because a put comes in and we end up buying the stock very cheap. But remember what very cheap is, okay? Because we're buying BA for $82. It was probably 90 at the time or more. It's at 129 now. So the only way we're even going to initiate a trade in BA is if it drops considerably from where it is right now. That goes for most of these guys. They're mostly things where we have 15 to 20% discounts. In fact, we have a video that says how to buy a stock for 15 to 20% discount. That's what we tell you to do. Don't buy the stock, sell the put, and promise to buy the stock if it gets cheap. Now, which stocks got cheap? Well, in fact, you can tell, there's a story to all these. Apple got cheap. ABX got cheap. Barrick Gold, that is. BHI got cheap with the Baker Hughes deal. CMG got cheap on the scare of Salmonella, whatever the hell it was, E. coli. Coach got cheap. They had luxury sales. Disney got cheap. The ESPN scare. Expedia got cheap. God knows why. FCX got cheap. Obviously the commodities problem. GNW got cheap. That's the insurance problems they had. IBM got cheap. Everybody's freaking out about IBM for a while. iRobot got cheap. People panicked out of iRobot. Lumber Liquidators got cheap. Boom. Everyone's got a story, right? All these times that we ended up owning the stock in a long-term position, it's because something bad happened to the stock that we did not consider permanent. That's why we have these positions, because something made them so cheap, they became compelling enough for us to establish long-term positions in. And that's what so those are our trees. And we have bigger positions in those. Look at the numbers here. 20, 40, 40, 20, 30, 20. We have bigger positions in those. 20, 20, 20, 20, 20. Mostly here, we'll take like 10s and 5s. Okay? When the stock gets cheap, we'll tend to double down on it, because what do we have in the initial trade? We have 1/4 allocations. 1/4 allocation block. So, and what's an allocation block? Let's talk about that. An allocation block means if I have $1 million, any portfolio over $200,000. At $100,000, maybe you want to have 10% allocation block. So in other words, each position, you should allocate $10,000 to the position at maximum, right? Once you're up to $200,000, though, you should really cut it down to 5%. Anything over $500,000, you really want to have 5% allocation blocks. And that means realistically, you only want to have about 20 things in your portfolio. You shouldn't have more things in your portfolio than you can wake up in the morning and punch in Yahoo Finance and go through all the tickers and read all the headlines to see what's going on with all your tickers in like a half hour or less. So if you have 50 positions, there's no way you can keep track of 50 positions. Okay, there happen to be 50 positions here, but only 21 count. Only 21 are actually active. The other ones are all placeholders where we say, well, if they get cheap, we'll buy them. Oh, I guess these count too. I'm sorry. Okay, these are full stocks, so we have dividends. These are my dividend stocks. If a stock pays me a dividend, I'll buy it. If a stock doesn't, and I don't mean a little dividend like Apple's 2%, but if a stock's paying like a 5-6% dividend or something like that, I'll buy the stock. But if it's not, I really don't care if I own it. What do I want the stock for? I'd rather play with the options. So where were we? All right. So I was going to say allocations, right. So in this case, we have a $500,000 portfolio. So initially, we had 20 allocations of $25,000. Now, of course, you have margins, so figure $1 million of buying power. So we'd have really 20 blocks of no more than $50,000 in a $500,000 portfolio. Now, you don't intend to use it all, but that's just what the maximum allocation for any one position should be. So, when we initiate a position, though, we try to always initiate with a 1/4 commitment. So, so the stock, in other words, we don't want to be obligated to buy more than, if it's a $50,000 allocation block, we don't want to be obligated to buy more than $12,500 worth of stock in the trade that we set up. All right. Now, the good thing about that, though, is if you follow that rule of thumb, you're not going to lose a lot of money, because even if your trade you pick is a complete disaster, you're only going to lose $12,500 out of a $500,000 portfolio. That's a smart way to structure your business. It's a very basic concept. Now, there's articles in the education section. I don't know. God knows where. Oh, you know what? If you go to the wiki, see in the wiki? That's a better place to find stuff like this. It's also very slow. Here you go. All right. So in the wiki, you'll see links to smart portfolio management. See? Tactics, skills to develop a successful day-by-day trading. Boom. Information with, ins and outs of PSW, shortcuts and strategies, basic core strategy. I mean, stuff like that's the way you find things like this. So here we have smart portfolio management. This is where we talk about allocations, position sizing, that kind of stuff, okay? So I'm not going to get all into it here. It's right there in the, read the effing manual is what they used to say to me. All right, so anyway, in an allocation system, this is how we plant our trees, though. We plant a lot of trees. They're not all going to live, right? Anybody who's done gardening, you know that, right? You plant stuff. It doesn't all work, but you plant enough stuff, and you nurture the ones that work, and the ones that don't work, you rip them out of the ground and try again. You take a loss. Now, it's funny because people are not willing to do that in portfolios. They don't like to move or change positions, but we do that all the time. We eliminate positions and we decide we give up on things. Now, sometimes, in fact, obviously our biggest losses are when we don't give up on things and we hope they're going to pull it out and they don't. Like GTW last year or ARO this year, they didn't make it. Okay, we put money into them. We thought they'd come back. They didn't come back. All right, Baker Hughes, we're still waiting for them to come back, but they're okay. We're kind of good with where we are. In fact, this is where we targeted 45, so we're at 45. Here, why is that? Oh, this is a much older one. We originally sold the $70 calls. We just never bought them back. 55 puts is what we sold. So our real target is 55. We're really hoping to hit 55, but if not, we'll have to roll these. But I'm certainly not upset about this. I love Baker Hughes. Anyway, so these guys pay dividends, and we end up with a lot of shares of the things that pay dividends or pay us returns over time. And as the basis gets lower and lower, you have less and less worries about selling calls against them, and you just collect that monthly income. But think about how big that monthly income is, because even if we're making 1% a month, right, that's 12% a year. But it's 12% on $1 million, and we only started with $500,000. So now we're making, so 120,000 is 20-something% a year in dividends and short call sales against a $500,000 original amount, and we're already kind of at that level after less than 3 years. So it's only tedious for the first year or so as you build it, and then it starts kicking into gear, and the position starts paying off. But you've got to pay your dues. And it's so hard for me to get people to do that. It's so hard for me to get to convey this to people. All right? So, meanwhile, this is a new high for the year in the long-term portfolio, 93.2, which is 966. Oh, almost the number of the blank find. Now, where do we go? Short-term portfolio. Now, yeah, that's great. 400, almost 400%. So the short-term portfolio, 498. Now, this started out at $100,000. So that's doing really well. Same time, too. We started both these portfolios, they're paired. So we started them on the same date back in Thanksgiving of 2013. This is more like our normal aggressive options trading that we do. We make a lot more money, obviously, but it's more risky. The reason this is doing so well is because I haven't covered this yet, but we have, we flipped bearish on SQQQ because we only had the short calls we cashed in, the long calls. When was that? The 19th, I think. which was a really, really good timing call. But essentially, the reason we're up 500%, 400% in this portfolio is because of these kind of calls. This is what we do all the time. We rip our hedges apart. When we feel the market went too low or too high, we rip our hedges apart. Now, I wasn't even aggressive because we also have these FDSs, which are dead. We also have these TZAs. We also had, these aren't really hedges. So we also had the TZAs and we had the FDSs. So when I pulled the SQQs, I wasn't taking a gigantic risk, but I was taking risk. These, by the way, are just basically write-off. We're actually losing, look at this, we're losing $19,500 of insurance, and we're still up at 498. We're still at our all-time high. That's our insurance, that's all. That's how come, what I say the other one was 966, so that's 966 plus 5 is $1.46 million. That's freaking great, starting from $600,000. So yeah, we're going to lose money on our hedges. We're supposed to lose money on some of our hedges. They're not all going to win. Oh, and this, by the way, this isn't really a total loss because we also had, didn't we have some short SDS calls that we bought back or something? I hope we did. Anyway, at some point I think we did. But, so these are just dead and we paid $195 for them. That was our insurance through June. Now we have to pick up some more insurance for the end of the year. And we'll probably spend another $20,000 to keep ourselves insured. That's the price of insurance. When you have $1.4 million that you're protecting, that's the price of insurance. It's $20,000 a half. Nothing wrong with that. All right. That's also why we'll never ever have a perfect picking record because we purposely pick things that are going to go against each other. That's how you balance yourself. You don't want everything to win at once. If all your positions are winning at once, you're doing something wrong. Let's put it that way. All right. Let's see. Apple. Oh, that was one question, huh? This isn't going to go well. How's the market doing meanwhile? Let's take a look. I forgot my futures. Damn it. No! Look at that. Okay. Now, here on natural gas, we were too long natural gas at 214. I wrote about that this morning, I think. That's good. So these are up 260 on two positions. And on the Nikkei, oh man, are you kidding me? Oh no, that wasn't here. So the Nikkei is at 1680. It's only up $200 on the Nikkei. And now the dollar's weakening though. I'd like to see if the dollar goes below 95.40, the Nikkei will come down with it eventually. So that'll be nice. And hopefully 1850 will get rejected here on. Here we can add this short. Let's add this short 17,850. We can add this short. So let's get one, and then we'll get another one if it goes a little bit over. So what I get at 49. That's close enough, right? So that's a good shorting line also. So what I have so far is short on the Dow at 850. Short on not the dollar, silly. Short on the Nikkei at 17, because obviously 17,000 is a great shorting line. I mean, I shouldn't even have to tell you that, right? And long on natural gas at 214, and you can see 214 forming up as a good line. So of course it was worth taking when it was back there, and we took it for the bounce. Now I should have taken the penny and ran. Well, I could still take the penny and run, but he's doing a little squeezy thing here. You see how it's zigzagging in and out like that, up and down? That's called a triangle squeezy thing. That's the official technical term. Here's one. See the triangle squeezy thing here? And what's it do? It resolves up. So now, hopefully, this one will resolve up. If it doesn't, if 215 fails, though, we should get the hell out. But if 215, if it goes up, it can go back over 216, maybe up to this purple line of 217. That would be nice. Okay, so since I don't think I'm going to lose any money particularly, and since I think I can make another $250 or so, I'm going to obviously I'll stick with it and see. But at about 215, I pull the plug and get out to lock in the money. So I have a very low tolerance for a loss, but I still think I can make another 250. So I'm not going to jump out of it. Yes, and there goes the dollar failing 95.40. So if the dollar can continue to fall, we'll be in good shape. All right, we'll come back to that later and see how it's doing. Now, of course, this is a cardinal sin, because if you're playing the futures, you really shouldn't stop watching it. That's one of the problems we always have with these webinars, is I then drift away. Where are we? So not looking at the futures is always dangerous. Apple, partial cover, I always talked about that one. Okay. Hopeful as well, blah, blah, blah. Yes, it is. All right. Damn it. I really hate the way this chat part works. So. There it is. Should be sending book-to-bill ratios in a row. What might the impact on the U.S. dollar inflation? Is she coming? And wow. Really, you guys got to write proper sentences because it's really hard to get around on this. All right. Two big semi-book-to-bill ratios in a row. What might the impact on the dollar inflation? Is she coming? Of course, there's going to be inflation. Wages are rising. There will be inflation. It will get passed through. It takes a while because there's obviously a huge amount of resistance by consumers to pay higher prices. So everybody's terrified to be the first guy to raise prices, but they will. And they have, in fact, frankly. That's another thing about the inflation is we don't measure it properly, so you don't really see what inflation is. When you break down the components of inflation, if you look at the things people actually do buy, there's tons of inflation. But that's not how the Fed looks at inflation. The Fed looks at inflation, they have something, 1/3 of inflation is something called owner's equivalent rent, which is a weird formula for your cost of housing for people who own a house versus what they could rent it for or something like that. It's just total bullshit, and they use that as a huge weighting on inflation and always makes it seem less. Another way they knock down inflation is what they say is, okay, look, aside from the fact that your iPhone is 10% cheaper than it was last year, right, for an iPhone, basic model, right? They say, here's a basic iPhone, it's 10% cheaper, but it's also 30% more powerful. Therefore, you have minus 40% cost to your iPhone. And you're like, what? That's how they actually measure it, though. They actually take the power of the iPhone compared to last year and say it's more powerful, but it's the same price. Therefore, that's disinflation. That's bullshit. It's a phone. I need a phone. If the phone's getting more powerful, I need a more powerful phone because all the programs are more powerful and I don't have a choice. It's just nonsense, okay? So, it's hard to discuss like nonsense and how it reflects other nonsense. It's just, but there is inflation. It's not going away. Global wages are rising. You're either going to have riots, which are expensive and people have to buy more security, or you're going to have inflation as people get higher wages, and then you've got the rising cost of Social Security, Medicare, blah, blah, blah. So all this stuff is going up, and eventually they're going to have to tax people more, and then the government will have to spend some money to appease the people, and we need infrastructure spending. There's going to be inflation. When and who knows? But we can't all be Japan. I just wrote about that today. We can't all be Japan. Japan got away with their nonsense for 20 years because they were doing it in a vacuum. They were the only ones doing it, and nobody cared. You can't have everybody do it. It's like, let's say Japan was the banker in Monopoly, right? And every time you pass go, they would take $1,000 and put it in their pile. And so they got rich. It didn't affect anybody else's game until you start looking at their giant pile of cash and go, hey, wait a minute, why do you have $50,000 in Monopoly? And they're like, well, every time someone passes go, I take $1,000. And you're like, you're not supposed to do that. And they're like, oh, sorry. All right, so that's what basically has been going on. And now other people, so here's the thing. Well, there's two things that are going to happen. Either everybody starts noticing that they're doing it, which we have, of course, and they say stop it, which we're doing, which is what the G7 meeting was just about. So either everybody says no, stop doing that, or everybody starts doing that, and that is what's been going on recently. But what happens if everybody just starts taking more and more money? The whole thing, first of all, it devalues what Japan's been doing so they can no longer help themselves by taking more money. It ruins the entire game. It drains the bank, and eventually the game falls apart. That's where we're at. We're at the part where the game eventually falls apart. How long that will take, I don't know. It's like saying how long until the polar ice caps melt. They're going to melt. They are melting. It's just a slow frickin' thing. It can last for decades. This won't last for decades. This will last for years, or it could last for years, or it could blow up tomorrow. It's not going to take much to topple the whole thing. Where are we? So on that happy note, if you think there's no rate hike in June, I don't think there's a rate hike in June because, wait, the Brexit meeting, right. But, here's the thing though. If the Brexit is off the table, which it is today, technically the Brexit's off the table because the most recent poll showed like a 5% gap or something like that between people who want to stay and people who want to leave. There's still 20% undecided, but, you know, they're figuring those guys are split 50-50. I don't think I agree with that, though. I think people who are undecided are more likely to say, I think the people who are undecided, due to the tactics that have shifted the polls, you know, where they're doing everything they can, from my article today, they did everything they can to scare the crap out of the people who want to leave the EU and tell them how horrible life will be if they leave the EU. Now, given that, to me, the 20% undecided are, in a large part, people who want to get out of the EU but aren't sure because of all the crap they're hearing. I think the undecideds are very much on the side of leaving, and I think that as, you know, look, it's a back and forth. It's like a political campaign, right? There's a huge attack from the people who want to stay, from the Remain camp, and they're basically saying to the Stay camp, oh, it'll be this horror flood catastrophe, blah, blah, blah. But now the Remain people, who have less money and aren't funded by the banks and aren't pushed by the government, but the exit people, they have to get themselves organized and get themselves a champion economist or something like that, like Stiglitz or something like that, and they have to get somebody to say, no, this is all bullshit and all their numbers are bullshit, and, you know, everybody, and they've been lying to you, which they are, you know, and they are bullshit, and those people are lying to them. If they can get that message across and clarify it in the next 30 days, this thing can swing right back to a Brexit. So, the closer we are to the closer you are to the UK exiting the EU, the less likely it is the Fed is going to do anything because that alone can destabilize the entire global economy. So if we pull rates and the U.S. economy dips, if the Fed miscalculates and they raise rates, and we have a 10% drop in the S&P when they raise the rates, and then 10 days later the UK exits the EU and they have a 10-20% drop in their economy, or in their markets. I mean, then you're talking about instant depression. Like essentially, you just basically taken a domino, knocked it down, and the other guy in the second domino hasn't even waited for your domino to hit. He just knocked his down too, and they're all falling like as fast as possible. All right, that's why I don't think they're going to raise it in June. Because it's just even the slim possibility of a Brexit is not worth the Fed taking a chance. They can wait. There's not enough harm in them waiting to justify taking the chance. So, what's the rest of that thing? What might be? No, that's the wrong one. All right, indices spike result. Will they spike as a result, despite your overall view? No, I think they're spiking now. I think people right now. We just talked about this last week. What I read last week said there's no way they're raising in June. And people have come around to that position. So that's in. That's what this rally has been about. So no, I don't think we're going to rally on top of the rally very much. I mean, of course, that day or whatever will spike up or come back up. But this is it. Look, 2100 is the top. It's still the top. It's a value top. You really can't convince me that there's a reason to buy the S&P companies over this range. You also mentioned cash in SQQ calls, but in light of this giant spike, why wouldn't you keep them on? We did. We put them back on. You got to read the Morning Post. We just put them back on. Is this a position in all the portfolios? Which one are you showing? We have various portfolios, and we showed a couple. We can look at those after. Let me catch up on the questions first. Jal says, what strategy do you employ when you enter a futures trade at 2131? What? And it has not gone up appreciably between well, I don't know. If that's natural gas, it's 215 now, so I employ the strategy of taking the money and running. I'm not sure what you mean. I mean, if you went, well, first of all, 213, that was perfect. Great entry. I don't understand what you mean by appreciably. How much do you think these move? You know, when you get a penny on the futures, that's big money. Look at that, it's $300 for a penny, or a penny and a half. Anyway, it's $150 per contract for this thing. I don't know what you mean, but that's a big move. So you lock it in. When you get over 214, you make 214 your stop. Because a penny is very exciting in the futures. And yeah, I take a $30 or $40 profit. I take any profit. I take 10. You guys have seen me on this thing. I take $10 profits and I jump up and down. I love winning. All right, me and Trump, I love winning. Winning is great. So, it's like I don't care because you know what it is. I'll take $30 50 times, and I'll make my $1,500 that way. I enjoy doing that, frankly. I enjoy making it. I love making $50. I mean, honestly, $25, $30, I'm not that excited. But if I make $50 or $100, I am so happy. I could care. I'm done with the trade as far as I'm concerned when I do that. If it looks safe, I'll stay in it. But if it doesn't look safe, I take the money off because there'll be another trade 5 minutes later. I don't just play. And again, I don't play one contract. I play whatever contract looks like it has the best chance of succeeding, not based on the position, but based on the news. Okay, what I care about is if I see something happening that makes me think that there's a good reason it's going to turn. If there's not a good reason it's going to turn, I'm not going to play it. All my trading is basically news-based. It's based on what's going on today in the market. Ken says, did you reinvest the dividends or take the cash for others? No, reinvest. No, we cash. I'm sorry. So all the dividends, just the way the portfolio is set up, it would be, also we don't do partials because we're playing options, so we wouldn't buy like 1 extra share or 2 extra shares when the money comes in. The dividends just drop the cash in the portfolio. All right, so that's how it works. Now, frankly, my mom's account, she spends her dividends. She gets money to dividends. That's her fund money. She goes on trips with that money. So it just depends on where you are and what stage you're in. But no, in our portfolios, we do not reinvest the dividends because it would be too much of a hassle. We don't want 2008 shares or something. We have to have even amounts. So we just drop the cash into the portfolio and run our positions. Now, if in a proper retirement account, when I was younger, yeah, I used to set up trips. I used to reinvest all the dividends and buy more shares. And then when I had enough shares, I would start selling. Then when I crossed the threshold, I would sell more options against those shares. Because that's how I like to build things over time. So it just depends how old you are and what you're looking to be and where you want to be in that particular stock, so on and so forth. Bill, do you expect us to break out of SPX 2100 this year? If we live through the summer, yeah. If we live through the summer, 2150 is my target for the year. I'm a little concerned that we don't make it because my assumption was we wouldn't make it, and towards the end of the year there'll be a little rally off of whatever sell-off we have in the summer, and we'll get over and we'll make a new high. But I really wasn't looking for much more in 2150, so it's certainly not an exciting move up. Nothing has changed that. I think unless the economy gets worse, and actually some of the trade data is showing it is getting worse, unless the economy gets much worse, I think this quarter that just went by will be the worst quarter of the cycle, and then we're going to start hopefully building from there. But in order to do that, everybody's got to not blow up. China's got to not blow up. Japan's got to not blow up. Europe's got to not blow up. And of course Canada, Mexico, whatever. Everybody's got to behave themselves. That's a lot of people have to behave themselves before we can start saying, yeah, we're going to be stronger. I'm also concerned because of all the financial engineering that went towards making the earnings where they are. I think people are getting fed up with that also, and if there's a backlash in that, we could reprice lower. So, it's like, I think right now we're at the right place. Right now, 2,000 on the S&P is where we should be. Okay, maybe 1,900 on the S&P is where we should be right now based on the earnings that we have now. But also with the implied stimulus we have now, I could see 2,100 or in this range. But if the stimulus, at some point they've got to raise rates, they've got to pull back the stimulus, they've got to try to let the market breathe on its own. I don't think, and then I'm not sure that it can. All right, so it's going to be rough. I don't expect much. I don't expect much movement this year and next year. I don't know. I don't see how they solve these things. I sometimes I look at the market, I say maybe I'm not that smart because I don't see how this is even solvable. But the way I look at it, I'm like, how could people be buying these crap stocks? And I'm not talking about Apple. Apple's got a PE of 6. So every 6 years they make all the money that you pay them for shares. So when you give Apple $105, right? They make what do they make? Am I confused? 1 minute. When you give Apple $105, let me look this up over here. Hang on a second. They make, it's not even 105, it's 100 now. So Apple is going to make $2 back. What? No, that's a quarter. Sorry, $10. Apple's going to make $10 back on $100. Okay, basically, so it's a PE of 10, but it's not really a PE of 10 because they already have $50 in cash. All right, so basically, it's like you're buying Apple, but Apple owns $50 in cash. So when you give them $100, you're buying the $50 in cash. It's yours. You're a partial owner of that cash. So that's why I always thought about them having a PE of 5 or 6. But either way, even if you look at it, forget the cash pile that they have. When you buy Apple for $100, they're making $10 this year. It's for real, not projected, not pretend, not targeted. They're making $10 this year. That's a 10% dividend. They don't call it that, but that's what it's. That's 10% dividend back on your money. You're getting 10% interest on your money. That's your return on capital. Whether it goes to dividends or whether it goes in their cash pile or whether it goes in whatever, you own Apple. You're an owner of the company. These are decisions that your proxy board made for you to say, here's what we're doing with all this money we have with our stock. But you own it as much as Cook owns it. You are an owner of Apple Computer. Your percentage is lower, but you still own it, and they're allocating the capital that way. So they're investing in growth. They're investing in this and that. Down the road, as in theory, as they make more money per share over time, then your shares become more valuable, and you can then sell or recognize your ownership gains by selling the shares as opposed to waiting for them to pay you dividends and such. So, was it just about Apple? I got sidetracked talking about Apple. Let's go with the whole question. So, what happened to that question? I don't even know where that came from now. I'm confused. All right. Anyway, what was my point about Apple? So, dividends, reinvesting. Damn it. Oh, anyway, so valuations, I guess we were talking about in general. So the bottom line is, I know, crazy valuations, right? So Apple is a reasonably valued stock, right? But there are so many stocks that I'm talking about, like Tesla, which is a complete joke. In fact, there's a whole article yesterday about how Tesla is actually a gigantic Ponzi scheme. And they made great points. They are a gigantic Ponzi scheme because all of their assumptions are based on bullshit that can't happen, growth that can't happen, financing that can't happen, and the way they recognize their revenues is ridiculous also. It's like it's nothing a real company would ever do, the way they play with their books. So there's too many companies like that, doing too many things like that are fine in the healthy market because nobody gives a crap. Everybody's growing. You say, whatever, they're cheating a little bit, who cares? But when it all hits the fan and you have to look at companies for their breakup value or whatever, like we did in 2008 and 2009, when you have to start looking at companies to say, well, what's this company worth if the world ends? If the entire financial system implodes, what's it really worth? Well, it ain't worth much. Okay, that's what we found out in 2009. They ain't worth very much if you don't think that the credit card, that your ATM is going to work tomorrow because your bank's out of money. Then who cares how many iPods Apple can make or a lot of other people? All of a sudden, you've got to start thinking about the basics, like where can I get a rock to hit my neighbor over the head to steal his food? That's what's valuable. So as the S&P, though, that's where we are. There's too many. We haven't adjusted. We haven't gotten realistic about pricing, and you can't really have a breakup to a higher thing until you recognize your problems. You can't move forward. What target would the SQQ hedge? I don't have a target to hedge. So if the market goes down, Or you think, why Target? Oh, I see. We sold the Target. We sold Target because I like Target. I think it's a good value stock, and I think that it's a nice offset. You don't have to go with Target. I printed it yesterday in chat. Where is yesterday's chat? Oh, what happened? Not Tuesday. Here we go. All right, so in yesterday's chat, I know Whole Foods was one of them. So let me find it. WFM. I made a list. Here we go. Yesterday I made a list of a bunch of stocks I liked. 8800 asked the question. I said I like Ford, I like Cheesecake Factory, I like Chipotle. ESRX is good but not great. And then I said, here are ones I like. Marriott, Target, Walgreens, American Express, Boeing, United, Caterpillar, Textron, Whole Foods. Whole Foods has a whole new little thing they're rolling out. I think it's going to do well. Super Value, crazy low again. We like them when they're low. Bed Bath & Beyond, not Best Buy. Hewlett Packard, oddly enough, HPE shot up today, not HPQ. Actually, how did HPQ do? HPE went crazy. Here's HPE. Oh, please. Why are you being so slow? Anyway, we'll get back to that in a minute. eBay is cheap at the moment. AA is cheap. I think that there's a lot of use for them, and FTR, especially in all the new electric cars. People are going to start wanting more aluminum frames. And Frontier is always fun. They're a good dividend payer too. Oh, here's HPE up 7%, and by comparison, HPQ, I'm sure they're up a little bit in sympathy. Yeah, HPQ is up 3.4%. So this is yesterday I was talking about it. This is my current list of things I've got on a watch list that I'm keeping, and all these stocks are ones that I like. And then of that list, it got me looking at Target again, and I really like Target down here. And I tend to move on. The ones I move on are the ones that I think are more likely to pop, and I won't be able to get them again. So Target, see this U it made, or whatever you want to call it. See how exact that is? I think it's going to reverse, and I think you're going to see the same pattern going back up to the 80s. So I think basically this is possibly our last chance to get it down here. Might go a little low, but either way, I like them down here, and I feel very comfortable selling the put. So that's why I picked Target this morning, because I was worried it would get away from us. Okay, it's only up 1% today so far. But it doesn't have to be Target. It could be anything. That's the point of this list. It could be anything you're comfortable owning if it gets to a certain point. You sell puts against whatever one fits your portfolio and works for you. Now, for us, we don't have any retailers in the portfolio, and I like Target. So that was the reason. We have no big box retail kind of things in the long-term portfolio. We have it in the butterfly portfolio, I think, but not in the long term. And that's what this is about, because we put it in the short term. Anything in the short term portfolio that goes bad ends up in the long term portfolio. If we're going to keep it, like if Target, the puts went bad on us, we just flip them over to the long term portfolio and let the long term portfolio worry about it. We'll take the loss from the short term portfolio and then transfer very cheap puts to the long term portfolio. And again, it helps make it more successful. Because we take our losses in the short-term portfolio and transfer very cheap positions to the long-term portfolio. And again, that's the point, though, right? We take the trees that are working out, we take the ones that came in nice and cheap, we put them in the long-term portfolio and give them time to grow. If they make money quickly, we cash them in the short-term portfolio. That's why the short-term portfolio has so much cash. Now, had we not been, we oddly have been successful in both. They're not supposed to be both doing so well at the same time, but had we not been so successful in both, we would have transferred money from the short-term portfolio to the long-term portfolio, so we had more buying power, but we haven't needed it because the long-term portfolio has been making a fortune, and so has the short-term portfolio. So the money's kind of pooling in the short-term portfolio where we really don't need it. we certainly have no need for $500,000 worth of cash in the short-term portfolio. But on the other hand, we're not bullish enough to want to use it in the long-term portfolio either. Therefore, it just sits. Is inflation good for gold? Inflation depends on the kind of inflation and why you're having it. Wage inflation, not the best for gold because it's due to a real increase in goods and services and growth in GDP. Growth in GDP is healthy economy. Healthy economy is not good for gold. But money printing isn't ending anytime soon, and I do like gold whenever it dips, and it has dipped. But you got to look at the bigger picture. Not that dramatic, right? Here's 100. All right, it's actually 100.50 was our buy point. We go from 100.50 to let's call it 120.50. So let's just say it's a $20 move. Okay, so we have a $20 move in gold to 120. Forget this. This is an overshoot. And how much is an overshoot? 20%. How? Right? 5% rule says you look for a 20% retrace or a 20% overshoot when you hit your goal. So the goal from 100.50 is 200.50. I'm sorry, it's 120.50. Its 20% move is about 20.50. See that line? That's 20.50. It's exactly what the 5% rule is looking for from 100.50. Then we pull back how much? You pull back a week retrace would be $5. Would be $4. So $4 is 116.50, which is right here. Isn't that amazing? That's a weak retrace, and a strong retrace is $4 more down. We never got to a strong retrace. So this is still bullish. We're still in a bullish trend. So this is an overshoot. So the same way you can get a 20% retrace, you get a 20% overshoot. How much is a 20% overshoot? $4. How much is that? $4 on the button and rejected, and then it goes down back to the 120 line, and now $4 below the 120 line is 116. So this is 1,000,000% following the 5% rule. It's exactly doing what it's supposed to do. So if we're consolidating around 116, we can expect to move back to test 120, and then the critical test at 120 is going to tell us whether we go up to 124 and then 128 and start a new higher round, or whether we fail and head back all the way to the next the next line will be the 50% level, which will be about 110. So if this fails, if we fail at 116, we're probably heading back to 110. And then we'll have a very strong consolidation on that line, which I would be bullish. There, that's $1,100 an ounce, by the way. So at $1,100 an ounce, not $10.50, I would be about as bullish and banging the table as I was at $10.50. So basically, my expectations for gold have moved up 10% as a base. Now, the wild card in that, unfortunately, is all the gold producers have lowered their basis. The reason $10.50 was our basis for gold was because $10.50 at the time was the average cost of extraction for gold. Basically, they broke even at about $10.50 an ounce. That is no longer the case. Now the cost is down to probably $900 or less. For Barrick Gold, for ABX, it's down around $800 an ounce to pull gold out of the ground. So they could sell gold for $4,000. They're perfectly happy making $200 an ounce. Now, they would rather make more, but I mean, they make money selling gold at $100 an ounce, so they will. And they won't cut back production. So we could end up with a glut of gold. So if there's any restraint on the parts of central bankers, then gold will be a dead trade, and you won't really want to be playing it anymore. If there's any restraint on the part of central bankers, of course, being the operative term. Why the price action between M6 and N6 is so different? Well, because M6 is expiring like today, or close to today anyway, if it isn't today. So that's making it gyrate like crazy. So forget. I mean, it's not even worth paying attention to at the moment. Giles says, if things are not that good this quarter, then why is the Fed desperate to raise rates? Because you can't maintain those low rates. Those low rates cost money ultimately. It's fake. Rates aren't low because they should be low. Rates are low because they're being artificially depressed by the central banks, and that means that the costs are being incurred somewhere along the line. Also, the banks themselves, here's the other thing, the banks who the Fed works for, they don't work for you, they don't work for the government, they work for the banks. So the banks are pissed off because low rates means low margins on their loans. They can't make money. So the Fed is desperate to make money for their banks. They own the Fed. Okay, so the Fed will be unemployed if they don't figure out a way to make money for the banks. And we're cracking down on all the evil ways that they make money, so we have to do that. Please check the YM trade. Oh, I forgot about that. Oh, damn it, did I screw up? No, it's dead. Not going anywhere. Ooh, the dollar's is still low, but the Nikkei is not helping me out. But gas did pop up a little bit. That's nice. All right, so at this point, it would be time to check the news. So I'm going to try to get through these questions. Where do you see Amazon and all these self-driving cars and everyone seems to be raving about? Really, Amazon? Like AMZ? Yeah, oh, you said that in the next one. I don't see why Amazon and self-driving cars are coming up at the same time. I don't see Amazon doing anything with self-driving cars. They got enough things going on with them are huge projects. So self-driving cars, it's the future. You know, I mean, it's not that far future, but once people get used to the idea of being in a self-driving car, and you won't be able to avoid it because people, even if you don't like being in a self-driving car, your friends will pick you up in a self-driving car, and it'll spread, and people will start liking it better. In fact, there is already a PR campaign being put out by God knows who, but you'll hear it, so pay attention to the magazines and stuff. You're starting to read a lot of statistics that tell you how self-driving cars are safer and cheap, and they have less insurance costs, and they get in less accidents, and blah, 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 blah. So already they're starting the narrative that people who want to drive their own cars are dangerous fiends who shouldn't be allowed on the road. That's how you get people to stop driving cars and start having self-driving cars, by talking down the safety factor of saying human beings shouldn't be driving cars. They're too dangerous. It's funny because Maddie, my oldest daughter, she's 16 now, and she's just starting to learn how to drive. In Jersey, 17 is your license age, but they get a permit at 16. So it's weird because you know when you're teaching your kids to drive, you start thinking about things you haven't thought about in years. And one of the things you think about is, because I always point out to her things that distract you, right? Like cell phone distracts you, even if it rings, it's distracting, makes you look, and look what happens when you look. And she says, well, what about the other people in their cars? And I say, look, I am amazed that there aren't constantly head-on collisions. You know, when you look at the people who drive and the same dumb people you have to deal with every day in your regular life, they get to have a key to a car and get behind the wheel and drive while they're doing their makeup, while they're driving, and having a whole meal like on their lap, and talking and having kids screaming in the back seat, whatever else they're doing. It's terrifying that other people are driving cars. I'm not terrifying that I'm driving cars, but even me, though, I got to admit, I mean, I'm driving a car, I'm paying no attention whatsoever to what I'm doing. And somehow, like, I'll be another mile down the highway, and I realize I haven't even looked at the road in a minute, because I've been trying to find something on the radio or something like that. It is amazing that we can do it. But you know, for one thing, driving is so amazingly easy that you can drive thousands and thousands and thousands of miles and not screw up. But it's inattention. The thing that kills you in a car is inattention. And that's a human error. It happens all the time. It's the number one cause of truck fatalities is tiredness and inattention. It's all going to come to an end. You know, the limo services, it's cheaper, it's faster, it's better, it's more efficient to have driverless cars. For trucks, they're absolutely going to go driverless for trucks. There's no question about that. For taxis, they'll go driverless. Uber's absolutely going driverless. So it's going to spread really fast, and it's going to become a very normal thing. And probably Not my kids, but my kids will be the last kids. I mean, until like 20 years from now, a 16-year-old kid won't even be thinking of driving a car. That's how long driving cars have to live, about 20 years. And then by 20 years from now, the people who still insist on driving a car are going to be the fringe people. It's going to happen really fast because you don't realize the technology's there. It's already there, and we're making leaps and bounds improvements in AI and stuff. And it is safer, it is more efficient. But the weird thing is that the automobile companies are backing it, and they're very, very foolish because once you have these driverless cars, then why do you need to own a car? Okay, and Uber's going to make sure that's not what's going to happen. So the people to back are Uber, and Toyota just put their money into Uber. But even so, it's not enough cars. Everyone's still going to sell so many less cars. Because why would I own a car when basically all I do is push a button and a car comes from wherever they come from? Who cares where they come from? A car that's free goes, here's my call, comes and gets me, and takes me to where I'm going, and then it goes along its way. Doesn't need to park and take up valuable space, except for when it's charging itself or whatever. It won't need to park. It won't need to do anything. It doesn't need to sleep. It just goes to the next person. And when more cars are needed in a certain place, the big computer in the sky is going to send more cars to a certain place. It knows that at rush hour in New York City, it needs cars here. It knows that when the theater lets out, it needs cars here. When there's a concert, it knows that it needs cars in these places because it knows the demographics of who goes to the concert. All this is going to be done. And it's not, it's not like super sci-fi futuristic stuff. It's all stuff that we can do right now, and we are doing. And it's just a question of stitching together some technology, and all of a sudden, boom. And that's why already, which seems premature, but it's not, there's already a campaign to start vilifying driving. And you're going to see that pick up steam real fast. All right, May says, are we bullish on gold or nugget? No, I'm not bullish right now because I think the dollar is going to get stronger, but when the dollar gets closer to 100 and gold is whatever low it gets to, maybe 1100, then I'll be bullish again. But at the moment, long term, yeah, I'm bullish, but short term, I don't think it's a good trade. What are your thoughts about Rio? I like him long term. I don't find him extremely exciting. Rio, I like FCX. FCX is better to me because they have a mix of copper, oil, and gold. So you're hitting a more diverse materials play on FCX. We went long on FCX way down here, though, at 5. So they're already up 100%, but I still like them. Rio, you're a lot more dependent on copper, which is a tricky one. And, again, long term, I think they'll make it through. But I'm not excited about them. I find FCX a lot more compelling. Also, the options pay better. Would they be good for 22? Would Rio be good for 22? Is that the question? Huh? No, wait. Would Rio be good for 22? They're already over 22. But yeah, if you throw them selling a put or something, yeah. JW, confused. If you sell puts and the price goes below your put and you have to buy the stock, my question is, do you buy the stock or roll it? Depends on how you feel about it at the time. Everybody always wants a definite answer. It's like it depends on how much the stock is. Is it a good price at the time, or do you want to roll it, or do you want to just quit and take the loss? You're just as flexible then as you are later. Oh, and by the way, it's not if the price goes below your put, because as long as there's still premium in it, you're not going to get assigned most likely, or if you do get assigned, they're doing you a favor by killing the premium. You only have to worry when you're deep out of the money, and then you're really going to make a decision. Am I going to take the loss, or do I like it enough to double down or roll to a longer-term position? Those are just decisions you have to make at the time, though, but you make the decision just like it's a brand new stock. You say, okay, I'm looking at my stock right now. Do I want this stock for this price that I can roll to? Or should I just walk away and take the loss and not tie up my money in a bad stock? Most of the time, though, with the puts that we sell, we're thrilled when they get cheaper. We wanted to buy a 1/4 position at X, right? When it goes 20% below X, now I can buy a double position at 10% below, at 30% below where I wanted it. So yeah, I'm thrilled. I wish, like Apple, we sold the Apple 85 puts. I wish Apple went to 85. I think we sold them for like $10. So basically our net entry on Apple was $75. So what am I going to do? So if Apple goes below, and I have to buy Apple for $75, do I buy the stock or do I roll it? Am I going to roll it and say, no, I don't want Apple at 75? Not unless something really incredibly bad happened to Apple. So I would buy the stock, I would sell more puts at the 65 puts or the $60 puts, and I would then sell some calls to cover my position. That's Apple. If it happened to VRX, I'd get the hell out because it's a piece of crap. If it happened to Tesla and I was long for some idiotic reason, I'd get out. If it happened to Netflix, I'd get out. If it happens to Target, I'd buy more. And again, unless I find something out that's really bad, like that's what happened to VRX, right? We found something that's really bad. Lumber liquidators got cheaper, we bought more of it. Depends on the stock. New tech, you see biotech producing amazing life. Oh yeah. Biotech, oh my God, that's going to be, we don't know what, but they're moving in so many different directions. There's so many different companies doing such exciting stuff. I mean, I love it. It's like, for me, that's what I do when I go on vacation. I read these tech magazines. I love reading about the new stuff that's out there, like Popular Science, Popular Mechanics. I like to read the journals, read about things coming out. I'm very fascinated by all that stuff. But also, though, as a 53. So the 53-year-old guy who's been into science fiction and science my whole life, I will say that, yes, lots of exciting stuff, lots of cool stuff. Doesn't mean it's going to be ready for a long, long time. It's a tough process. People don't realize with biotech that they go through essentially the same kind of process that the pharma does with the FDA things. They have to get it approved. You're sticking things in people's bodies. You still have to go through an approval process, testing process, trials. All that stuff still applies. It's just not as publicized as the other, and their process is a little bit easier. But really, when they come out with new stuff that does interesting things, there's a lot put into it. And it needs approvals, and people are scared to invest, and they don't like to go in weird directions, and so on and so forth. Like they're printing kidneys now. They're 3D printing, replacement organs. That seems kind of crazy, right? But they're actually doing that now. They aren't putting them in people yet, but they're printing. You need a liver, they can print you a liver. I mean, that's game-changing. Okay, but you know what's weird about that? It means that they're really not very far off from printing a person. And frankly, printing a person, if you ever watch Star Trek, that's what it does. When they transport somebody, they're doing a destructive scan. So they're basically, what they're doing is they're scanning every cell in your body, but in scanning it, they destroy the body that you have, and they take it apart, and then they put it back together, they assemble it on the other end. Okay, so they take a cell, they move the cell. All right, that's how those things supposedly work. They're doing a scan, and then they print you on the other side. Although where the material comes from is a question, of course. But that's all it is. It's just basically the 3D printing a person, and they just reprint the thing that they took apart on the other end. But they're killing you every time you get into a transporter, and a new you is on the other end, who thinks you're the same person, but you're not because you're brand new. There's obviously a huge gap in between that of where the hell the pieces come from and where do the pieces go. But anyway, so you watch them now, and like in my lifetime, this is supposed to be the 23-something, the 24th, 2,300 Star Trek is. That's in 1960. We thought it was that far away. We thought a thing that could print, we thought 3D printers, which is what they call a replicator in Star Trek, was 300 years away. Or 400 years away at the time, I guess. It turns out we have them now. They're slow, but we have them. And they'll get faster. Okay, remember, a laserjet used to be slow. In fact, remember we had a dot matrix printer when I was in college 20 years ago, when I was in college, not 20, 30. All right, when I was in college 30 years ago, I had a dot matrix printer that was state-of-the-art. and it would go, it's still better than typing, right? And the thing would come out. And if you had to reprint something, it was like, oh my God, it was like, oh, I got to reprint it. You know, you got to wait 10, 15 more minutes to get a reprint. But that was great stuff, right? Now, 10, 12, 14 pages a minute, whatever the hell these things do, you know, you have it on your desk, it's a tiny little thing, costs nothing. That's 30 years. That's what 3D printers are going to be like in 30 years, okay? As soon as you press something, a thing pops out. That's going to be game-changing. And like I said, they're printing freaking body parts now. Now, that means in 30 years, if you have a heart attack, you'll go in the ambulance and they'll have a brand new heart, your heart, with your DNA and crap. Your heart will be ready for you in the hospital, a brand new one. They'll plop it back in. So is it going to be exciting? Yeah, it's going to be exciting. It's going to be cool stuff. Let's see. Baba. Oh, they're in trouble. Baba's got accounting scandals. I would stay far away from that. Would you long DX are up right now? I mean, I would, except it's too crazy. It's like, I don't like to bet on things. I think the dollar's going up. I think the general pressure is the dollar will be stronger because the Fed's tightening. Nobody else is really tightening, so the dollar should have upward pressure back to 100. But 95 is the correct price of the dollar. 100 is too high. 90 is too low. It basically will end up drifting around 95, but in the current environment, with our Fed tightening in the near future and the possibility of the Brexit wrecking the euro, obviously long dollar is the way to go right now as a potential trade. But again, I don't make bets unless I have a specific catalyst I can look at and touch and point to that's going to show me something's going to move. So there's not that with the dollar. I just think there's generally upward pressure. So if I were going to play it, I'd play it up. But I'm not playing it. I'm just watching it. Although peripherally we're taking trades and assume the dollar will go up, like weaker markets and things like that. We do assume the dollar is going to have a bit of an upward bias. In fact, I'd be super duper short on Japan, except I think the dollar is getting stronger. If it wasn't for Japan, if it wasn't for the fact that the Nikkei benefits from a strong dollar, I would be shorting the crap out of Japan here. But I prefer that kind of trade because I think the general pressure on the dollar is up. But rather than play the dollar, I could play the Nikkei short. I mean, I would play the Nikkei long if I thought the dollar was rising, but I don't. But I think I would. You know, I'd be much happier playing it. When the dollar turns down, I'll be thrilled to play the Nikkei down with it. I prefer those kind of trades. That's something outside that can affect. There are two reasons to short Japan, because Japan's a debt bomb and the dollar will be going down. Those are two reasons. I like to have at least 2-3 reasons to do something. Buy it with Morton. I love Morton stuff. What do you think of the oil report this morning? Yeah, it was mixed, right? There was I believe that basically the amount of oil that was taken out. The amount of oil that was taken out was like 4 million barrels, and then the amount that came in was 2 million, whatever the hell it was. I forget now. All right, let's look it up because now I have to find out. Dun, 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 dun. What time was this? 10:23. There it is. All right. So all right, not really. Well, minus 5.5 and then plus 2. So minus 3 million barrels of oil was used somewhere. And if we go to the EIA report, which we have to do now, so hang on. How much money am I losing in the futures while I do this? Petroleum status report. And we get the 1 o'clock PDF. That's a real one. All right, and we see, make sure we got the right one. Blah, 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 blah. Decreased by 4.2 million. That's right. Okay, so basically what I care about is product supplied. The same amount of products were supplied. That's interesting, right? Refinery activity. Refinery activity was the same. So really, that's distillate. But you see crude oil same, cap utilization same, basically. Gas production same. Everything was the same. So more product wasn't supplied. More product didn't go through the refineries. Overall, The stock, see this, it's more this accounting bullshit. Can you see here? It was 3.8, now it's 2.9. So it's gone down by 1 million barrels. Not even a million barrels. 900,000, wait. 3.8 to 2.9 is 9, yeah, it's 900,000. So only 900,000 barrels actually left inventory. This is all bullshit. And again, where is it? It's here, it's other oils. See other oils? This is where we had it last time. A 2 million build in other oils, which is not measured in the report. So they're doing the same con game they did last time. Everything else is the same. The only difference is it's an accounting gimmick. They took the barrels of oil, so instead of counting the inventory into gasoline, well, I'm sorry, it did go into gasoline, but instead of counting a build and distillate, they instead put the build into other oils. And so it fakes a demand. It makes it look like there's demand. That's all. It's just bullshit. And it's the kind of bullshit they want to pull off during the holidays because it can keep the prices up. That's all. Oh, New Scientist. Yeah, I've read that one. CL contract closeout. Oil was still rising on today's biggest contract closeout. Does that mean more people are shorting than once? No, you can't go by that. It's the bottom line is, look, oil is they're gonna push oil to 50 because they want to get 50. Oh, look at that! Look at that! Look at the natural gas go. All right, I gotta take that. It hit my line. Yay! Who doesn't like making $600, right? 580, very nice. Oh, only 35 on the Dow. That's a shame. And the Nikkei, meanwhile, has a dollar. The dollar is still weak, so I'll leave my Nikkei trade on. I like the fact that the dollar is still weak. The Dow isn't topping over where I shorted it, so I'm happy with my Dow trade. All right, but I took this money off the table, so I don't care if it goes up higher. I'm thrilled to make 580 while we were talking, right? So that's great. That's what we were talking about that earlier, too. I'm excited. I love 580. To me, it's good money. Everybody's like, it's not enough money. I'm like, I don't care if you could make 1,000 on something. It's like, I'll make 580, and I'll make it again later, and I'll make it again tonight, and I'll make it tomorrow morning. You know, I'd rather make a bunch of quick, short ones that have no stress at all than sit there and watch it and stare at it for hours and hours to hope I get an extra couple $100. Not worth the time. Because again, I picked natural gas because I thought that was a good floor. At 217, would I go long again? No. I do think it will go up higher. I think we'll hit 220. But I wouldn't right now place a brand new bet on 217 going up. And if I wouldn't place a brand new bet, why should I let my bet ride? Take the $600 off the table and be happy. Right? Wait till there'll be another very obvious trade at a better price later. Maybe not natural gas, maybe it'll be the Nikkei, maybe it'll be something else. I don't care what it is. It's when I find out something that I think makes sense. And what I found out before with natural gas is it hit a really good floor that we could count on. All right, so oil contract closeout. Getting paid. So anyway, so when there is a closeout, though, you assume there's some downward pressure and that will abate itself at some point. But that's done. I mean, that happened last week. So now they're free to play and manipulate the market for another week or two. The pressure is only in the last 2 weeks until the contract rolls over. Once the contract rolls over, they have no more pressure, and that means they can manipulate the price up and up again, which they're doing. And now we're at what, 40? Oh, still at 49.39. That's weird. Wow, really sticking on that price, huh? Getting paper line and rolling. I know it's so weird that you say things like that, and I think of like telling that to my kids. My kids are like, what's a roller? What does that even mean? I'm like, well, there used to be little holes on the side of the paper. You had to line them all up. Oh my God, what were we doing? It's like we were cavemen. It is funny, isn't it? If oil hits 50, you go short. I would go short off the $50 line just because it's almost certainly going to be a point of resistance. But I'd also take a look at Brent. Brent. There you go. I would watch Brent also. You want to see if Brent gets, it's not oil Our oil might get, well, they're lined up now, actually. They're real close. But I would expect Brent to get rejected off 50. If Brent punches through 50, I wouldn't short us at 50 because Brent didn't get resistance at 50. You know, they got the same computers over there running the same trading programs over there on the same news that we have. So if Brent doesn't hit technical resistance at 50, then why should we? But again, if we were, you know, we always trade in tandem with Brent. But wait, gotta line these up so they're the same. Okay, we always trade in tandem with Brent, of course. Now, if for some reason Brent, we were at 49 and Brent was at 50, then I would short 49 because Brent's going to get rejected at 50. 50 is a good line. I don't care if it's on our oil or their oil, but 50 is a good line. If Brent doesn't get rejected at 50 and we hit 50, I might not want to bet Brent short 50. You know, and so again, this is a very important point on a lot of these things. You guys ask a lot of questions like that. I will go short if the circumstances dictate that it's a good time to go short, but I have to look at, I got to look at a dozen other factors, not just a $50 line. If you trade only on technical things, you will get crushed because you're not taking into account, did the dollar go up or down? Was there any kind of news? There's an OPEC meeting coming up in June. That's like 2 weeks. There's an OPEC meeting, so the rumor stuff starts again, and things can go flying up and down $5 while you have your short on. All right, so do you feel comfortable putting money on an option contract and then somebody in Saudi Arabia makes a comment to a reporter and it jerks up or down $2 on you? Are you comfortable losing that much money? All right, now, if somebody makes a comment now and it goes up to 50 and slows down and it looks like it's getting rejected and I don't think the comment merited enough attention that it should be over 50, then I'll make my short. But it depends. It depends on why it went to 50, how it went to 50, and what I feel about oil from the next, you know, after that point. There's no such thing as saying I would short at 50. That would be a terrible, misleading thing for me to say. I would like to short at 50. That's basically the way it should go. Just to clarify, if the dollar goes down, should we short the Nikkei? Okay, if the dollar, again, all right. If the dollar goes down, that's bad for the Nikkei. It means the yen's going up and it's bad for the Nikkei. So you short the Nikkei. All right? But why is the dollar going down? What happened? What were the circumstances? What caused it to go down? What's going on in Japan? Do they have any news? Is there any other economic news affecting the whole thing? Is the dollar move a temporary thing? Did somebody say something? What? But in a vacuum, yes, if the dollar goes down, then you want to look at maybe see if there's an opportunity to short the Nikkei. But that's the beginning of the trade, not the end of it. That's the beginning of you examining the trade to decide what's going on. Will the bullshit that keeps oil prices ever correct itself? No. It never stops. I mean, I've been ranting and raving about this stuff for like 10 years now, and it never stops. I mean, publicly ranting. I've been ranting and raving about it for 30 years prior. But I've been writing about it for 10 years, and believe me, it never stops. It doesn't matter what you say. It doesn't matter who you say it to. It doesn't matter if you go to a congressman. It doesn't matter if you prove it to a congressman. It doesn't matter if you get his whole staff to investigate something, because I've done all this. It never stops. They're too big, they're too powerful, they have too many levers, and they have too much money. So there's no such thing. It will never stop. They may lose ground. It's a battle, and sometimes they'll lose ground because the truth sometimes wins out over all this money and whatever else. But you know what? They'll then come right back at you, and they'll find another way, which is what they're doing right now, frankly. I mean, what they're doing right now is they found another way to jack oil up into the summer because they were down on the ropes all spring, right? All winter. They were down on the ropes, down at 30s. And barely at $40, and they were on the ropes, but they came back. And you know why they come back? Because they hire an army of guys like me who are like world-class consultants, and we tell them all the different tricks that we can come up with to make oil come up. And they hire PR guys, they hire publicity people, they hire rebels who go and break pipelines and then cause a ruckus and write nasty letters and things like that, and call attention to all the risks in the market. You know, it's like it's ridiculous. It's a gigantic game. So it will never stop. But yeah, as long as you realize it's a game and you watch the bullshit as it unfolds, you can make a ton of money trading it. But you just can't fight the tide. You know, you have to say sometimes there'll be ground going, sometimes ground will be gained, sometimes ground will be lost. You try to get on the right side of it, and you try to move with, you know, go with the flow. But there's no such thing as a win or a lose. It's going to go up, it's going to go down. And you just have to look at where you are at that particular time, what the repercussions are going to be in the little channel that you're in, whatever time period you're in. But it's a nonsense market. It's not real at all. Most commodities are not real. There's no real value to a commodity. There's no real value to a stock. There's no real value to fiat currency. There's nothing backing your currency. It's God. How much do you trust God? Shouldn't it be, since the money says in God we trust, right? Shouldn't it be as much, if you don't trust God as much, it should be worthless, right? If I don't trust God, why would the money be worth anything to me? Because that's all it's backing is your trust. So, you know, it's all nonsense, and you just got to really just accept that, though. It's all a bunch of bullshit, and all this markets are bullshit. All the money is bullshit. But it's a game we all agree to play. Now, Jess says, markets equal your ATM. Do you ever lose? What's your success rate? Well, the futures, I mean, yeah, I lose. I've lost scary amounts of money playing the futures. I don't do that anymore, but now that I'm old, oh, look at that, 218. See, I just lost an opportunity there. So yeah, I lost $50,000 on an oil trade going to I left New York, and it was Thanksgiving. It was Thanksgiving. I was going to Houston today for Thanksgiving, and I made a trade on oil. I think I shorted. I think oil had gone way up. This is many years ago. I think oil had gone way up, and I shorted it because I figured that by the end of the holiday that it would calm back down again. And then while I was on the plane, something blew up or something happened. Oil went up like $5. I had like 10 contracts. I lost like $50,000 on 10 contracts while I was on a freaking plane. I made most of it back because I doubled down. Instead of taking the loss, I doubled down, but that's beside the point. You know, it was ridiculous, and it just got more ridiculous, but the bottom line is a spike. Most people capitulated on it. So yeah, you can lose a ton of money on these things if they go very badly against you. As I've gotten older, I mean, that was when I was first married, so that was like 20 years ago. As I've gotten older, I don't take chances like that anymore so much. Although I think we had a huge negative on natural gas last year that we ended up turning into a winner. But for a while, we had a huge negative because it went against us. And even though it went against us, I was like, I still have faith in this. So we added to the position. It got to be a large position. When it went up, it made a ton of money. But for a while, it was down like about $20,000 or $30,000. So yeah, I mean, they don't all win. Don't ever think that, because you can easily lose money. But percentage-wise, I do very well on percentage-wise, and that's why I sort of got into more of a habit of just taking quick money and running. Because I just don't need that kind of hassle anymore, so I don't do it. You know, I'm much happier just moving along. I mean, I certainly do well enough at this point in my life, though, where I plan when I retire to just trade the futures in the morning and be done. So every morning I'm going to wake up, I read the paper, I'll trade the futures, and depending on how much money I make that day, I'm either going to go do something expensive or do something cheap. That'll be my retirement. Yeah, so basically all my spending money will come from my futures trading. Where are we? Okay, oil hits, okay, we talked about that. The dollar down, should we short the Nikkei? We talked about that. BS keeps prices of the oil. Oh, and then, when you said ATM, right? So success rate. So yeah, we actually, I think we tracked it for a while. We were doing like 70+% on our futures trading. So, you know, as long as you're frankly, if you're at 50%, you can make money, because as long as you have a stop loss principle, as long as you stop out with a good, as long as you stop out cheaply and let your winners run a little bit, then the fact that you have the same amount of winners and losers, you'll still win because your wins will exceed your losses. Once you get past 60%, though, you're going to make a fortune, again, using a good stopping system that stops you from taking huge losses. As long as you do that and make sure you keep your losses very manageable and win back what you lose, everything else is a bonus. And then it's just a matter of how many times you trade, because you can actually increase your output considerably. You know, if you had a broken slot machine that paid off 51% of the time, right? And so half the time you lose and half the time you win, but 1% extra you win. What do you got to do? You just got to play a lot, right? So that you have to make the law of averages work in your favor. And when you hit a streak that takes you to 57%, let's say you win 400 rolls, you hit 57%, and you know the payout is 51%, then you stop. And you say, you know what? The chances are I'm going to revert to the norm, so I shouldn't keep playing. That's another thing people don't do, right? People get on a winning streak and they actually increase their betting. That's the dumbest thing to do. When you get on a winning streak, you have to say, well, I got a good winning streak. I should set back to 0 because I think I'm probably going to hit a losing streak at some point. So why should I keep putting more money in? That's one of the reasons we cash out our portfolios too. Last year, when our portfolio got so far ahead, when we hit 40% on our long-term portfolio the first time, it was way ahead of the game. It was we were aiming to make 20% a year. I know it seems silly now, but we're so far ahead. But we were trying to make 20% a year, and by the end of the first year, we were at 40%. I cashed out. So I said, this is not likely to continue. You don't make 40% a year on a bunch of long-term positions. So if you're making a ridiculous amount of money and it seems stupid, and this goes to any stock you're in too, if you make more money than you thought you were going to make, take the money. See, natural gas stopping at 218 now. It's getting boring. 20 bucks, that's it. All right, so we got 300 here though. Yeah, the dollar's kind of fluctuating. If the dollar goes over 95.40, I want to get out of all this. Both of these are dollar down. Well, actually they're not. The Dow, theoretically, if the dollar really drops, it holds the Dow up. But at the moment, the Dow's weak and the dollar's dropping, so I consider that negative on the Dow. The dollar dropping, of course, is bad for the Nikkei, and the Dow dropping is bad for the Nikkei. So we'll see if this trend continues. I think 17 is way too high for the Nikkei, and I think we can get, again, it goes back to how much do I think we can make? I think we can get all the way back to 16.9. That's a lot of money from here. That's 70, 350. It's another $700. We can get to $1,000. So I'm willing to risk my 300 to make 1,000. I'm not. But if we go back over 80, I'm going to take 200 off the table. So I'm really risking 100 to make possibly as much as 700. That's the way I'm looking at this trade now. So I'll stick with that. That's worth it. On this one, I wasn't going to risk 600 because I didn't think it would go past 218. So I didn't want to risk $600 to make another 300. That wasn't worth it. I know it sounds worth it, but it's not. I like to have, if my reward isn't at least double my risk, I really don't like to take the trade. Oh, that's really important too. That's risk management is hugely important. Something you really got to take into account when you're making your trades, especially futures trades. How much can you win? How much can you lose? And if your win can't be twice as good as your loss, don't play it. But if your win is twice as big as your loss and you actually have that discipline to stop out, then you only have to be right half the time and you're going to do great. What was the YN level we shorted? 17,850. Is there any way the dollar can stay here or go lower with the hick in July? Hick. That's a lot of words that make no sense. I mean, really, you guys have to think about what you're saying here. Is there any way the dollar can stay here? Yes, it could. Or go lower? Yes, it could. With a hick in July. I don't know what a hick in July is. With a tick, with a thick, with a bit, click, chick. I don't know. Hike. Oh, hike. Ah, yeah, I could not figure out what you were talking about. All right, let's try that again now. See if I can figure this thing out. Is there any way the dollar can stay here or go lower with a hike in July? If there's a hike, no, the dollar goes up, okay? End of story. Now, if the Fed tightens, the dollar goes up. If the Fed doesn't tighten, then maybe the dollar doesn't go down, but it's not going to go down much because until the Brexit vote is done, even if it seems a runaway, until that Brexit vote is done, the euro is going to have people being nervous on it, and money will be in the dollar and the yen, frankly. But after that vote, all hell's going to break loose in the currency market. It's going to be very interesting. Where do you see a good bottom for SDS to go long? 70. There's no bottom to SDS. It's all about the S&P. Okay, SDS is just the thing we're trading, but it's about SDS. The SDS is a ultra ETF that's a reflection of the S&P. So there's no such thing as a bottom for the SDS. I do think, obviously, here is where the S&P hit 2100. So here, which is 18, is technically the bottom because I don't think 2100 gets breached. But it's not about SDS. It's about where the S&P is at the time. So we look at the, here's the S&P. So here, see that 2100? That's the bottom for SDS. I don't care what SDS is. Now, here in November at 2100, let's see what SDS looked like. See, in November, SDS was at 19 when the S&P was at 2100. So SDS is decay. SDS is one of those ultras that has decay. SDS at the same S&P level 6 months later is the dollar low. So you need to know that about SDS. SDS will fall apart at a rate of $1 every 6 months. It'll grind itself down. That's why when they're high, it's great to short these ultras if you have a reason to short them. So if the S&P was down back at 1850 and SDS was back at 24, I would be excited to short it. Because I know that over time it's going to grind itself down anyway, even if the S&P stays at the same level. So there's a huge advantage to using the decay of the ultras to your advantage, in your favor. But in fact, here, this is exactly, see this blue line? That's the decay of SDS over time. That's how much it loses value in a static S&P. There's wonderful ways to play that. When you know how these ultras work, there are wonderful ways to take advantage of that. Okay. Thanks, the NG trade was hard. It's hard to take a gain. Yeah, it's so hard. It's so awful taking money off the table. If currency is currency is fiat, and there's a lot of trust in the currency, would you look at the digital currency and how would you play? No. Why would I trust? It's more bullshit. No. There is going to be a scandal in digital currency. I have yet to have a serious conversation with a digital currency player who did not have a boatload of money. In other words, when you talk to these guys who run these digital currencies, and I mean every single one, they always think it's okay that they've got $1 billion worth of it. In other words, they go, oh yeah, I think this thing will be worth at least $10 or $20 one day. And I'm like, wow, really? It's like only a penny now. And they're like, oh yeah, sure. When you get down to it, a lot of them won't tell you what they have, but when you actually talk to them, they're like, oh yeah, because I was the only guy mining it when I invented it. And so I've got 1/10 of all the currency out there. So if it ever gets to a $10 billion valuation in the total currency, like Bitcoin is about that, if it gets to a $10 billion valuation, then I have $1 billion, or I have $2 billion, whatever. I have 10% of all the currency out there. And you're like, it's like, don't. How is that real? Now, honestly, though, that's what the government did too. When the government invented dollar bills, they basically had a ton of them, and they gave them away, and then they said they gave them away enough until people started using them, and once people started using them, they had value, and the government made a ton of money. So the government essentially did the same thing all the digital currency people do. They made up some money, they printed it up, they distributed it, people started using it, and it gains value. It wasn't worth crap when they printed it. It wasn't worth the paper it was written on when they printed it, literally. But because they got it into circulation and people started using it, it became valuable. That's not going to happen. All of a sudden, people are going to jump on Bitcoin. What you're going to have is you're going to have these scandals because one of these guys isn't going to be careful. One of these digital currency guys is not going to be careful with his money or with the way he uses his money, and it will become a big scandal that this stupid 18-year-old kid is now a billionaire because all he did was mine a bunch of Bitcoins or whatever kind of coins, and now he's incredibly wealthy because his coin caught on for some reason. And everybody who's got these coins is going to realize, oh my God, are we stupid? It's a big giant Ponzi scheme. Because the first guy who does it has all the money. And everybody else is just enabling him to get rich. No matter how good you think you're doing on that currency, the guy who invented the currency has the most of it. So it's just a scam. I mean, and again, if you say, oh, it's the currency, blah, 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 it's this coin or that coin. And frankly, I'm endorsing Green Coin X. I like Green Coin X. It's a good thing. I'm going to enjoy. I'm working with that guy now. But there's no difference. It's all the same. It's just a question of which one catches on and which one doesn't. But I'll be writing about Green Coin X maybe over the weekend. It's actually, it's a digital currency that's not private. In other words, that has no privacy to it. In fact, it's the opposite of privacy. You can't touch it without having your transaction logged and your self-identified. And I like it because it's different, and I like it because it takes away all the drug problems and all the other problems and all the illegal smuggling issues and everything else, because you've got currency. It's like a credit card almost. It's completely tracked and identified. No one can steal it. No one can take it. If I send money to my cousin in Europe, then she gets the money, and there's a transaction logged forevermore that you can look back and see everything that happened to your particular blockchain forever. From the day it was created until the day it got in someone's hands, you know every single person who made a transaction on it. And that's not a bad thing. So I'm very interested in what they're doing. But again, it's still bullshit because the guy invented it. He just invented it with a different, it's basically the opposite of what every other currency is doing right now. So when you say, how would you play it? You play it by jumping in early. And we did. I already told my members that we're going to back this guy and we're going to look at it. So some people picked up some of it. It's called Green Coin. There's a thing called Green Bank. It's being funded by these guys, GRNB. These guys, Green Bank Capital, right. And it's a little Toronto bank, worth nothing, okay? Now, again, when you say there's nothing wrong with it, Green Bank, who's Green Coin X, right? It's brand new. It's a brand new concept. It hasn't gotten any traction yet or anything else. They got a 2.5 million market cap. But you know what? If this thing catches on, they've got $1 billion worth of frickin' coins. So in the bank, and it's theirs. There's another billion, it's 10 billion more distributed. That's there to be mined and distributed. So you can play the currency. But I'm like, well, why did I play the currency? I'll play the guy who's already got $1 billion worth of the currency. In this case, it's not some kid. It's this Greenbank Capital that created this thing. All right, and again, it's a fucking Ponzi scheme. It's not real. It's all garbage. Okay, but how would I make money? If I knew Bernie Madoff and he was running a good scam and I could invest in his scam early on, I'd be one of the people I'd be one of the guys who actually makes money. His early investors made a fortune. If you were smart enough to invest in Madoff early and you died before, or you got your money out or you died before the whole thing blew up, you did great. And that's what these fiat things are. They're freaking scams. So get in early. Find one that's popular. Latch onto it. But don't fool yourself into saying, oh, it's going to replace the dollar or anything. It's not. It never will. Okay, the governments of the world will shut all these people down before that happens. But they don't mind that. To have people play with it now, they don't mind. It's fun, and there's uses for it. But it's not even a tiny drop in the bucket compared to what real money is and real currencies. All right, now you're talking about Danish currency. I believe me, I got bad enough time watching. I don't even watch the pound. I watch the dollar and the yen and the euro, and that's it. I really do not have time in my day. I mean, I'm not a currency trader, so I agree. It's a good thing to say. So is the franc, and so is this. It's like currency trading is a whole different ballgame, which I'm certainly not going to get into. Are you bullish on Twitter 13? Yes, I am. Absolutely bullish on Twitter. In fact, I was just quoted in Forbes yesterday or something on that. Twitter. I mean, the bottom line with Twitter is they're simply failing to monetize their stuff. But they've got plenty of users. Their users are being incredibly undervalued compared to other people. That's the point I made in Forbes. Is I said, look, a Twitter user is being valued at like $30 per user. A Facebook user is being valued at $400 per user. A Snapchat just got a $20 billion valuation yesterday. Somebody just put money into Snapchat at a $20 billion valuation. Snapchat has half the users of Facebook, of Twitter, and Snapchat's now worth like double what Twitter is. Makes no sense. So Twitter's users, and there's nothing better. There's not more text in Snapchat. There's not more opportunity to advertise or anything like that. There's nothing better about Snapchat. It's just that they're fresher and newer and seem like they're more exciting than Twitter is. But it really comes down to how much an eyeball is worth. And eventually it'll normalize. And it's going to normalize. Twitter's on the low end. Facebook's on the high end. Somewhere in between is the right price. So I like Twitter down here. They have a lot of room to move higher. And what's going to happen is they're going to hit this line here. It's descending. They're going to break over. They'll consolidate here. They'll probably break up, and they'll come into back around 20. And all it's going to take is like one good report. It doesn't even have to be a great report. Just a decent earnings report. They can do that. YM, the trade is down. Yeah, I'm sure it is. Okay. Oh yeah, we're pumping up into the close. Well, that's why we only have one. So that's not good, but I do like it, so I'm going to hang on to this one. I mean, it's only one, so I don't care. On the Nikkei, I said I would take that off. No, but the dollar's going lower. So the dollar's going lower, so the Dow is doing badly. But I'm happy to hold that one. I really don't see this line here. It's red, 17.9. I'll be happy to double down or up around that line and then see what happens overnight. On the Nikkei, with the weak dollar, I think that the Nikkei is going to fall off when Japan opens. So I like them. I still think they're going to hit 16.9. So I'm going to leave both of those on the table for now. What time is it? Ooh, wow. Why don't you guys tell me I'm supposed to end this thing? Yeah, people. What are your thoughts on Baba? We said that Baba. Yeah, stay away. Just stay away. Probably bad, but who knows? And, you know, it's an overvalue thing anyway, so I wouldn't get into it. Would you enter TCA-based hedges right now? I haven't into any hedges right now. Yeah, because everything's kind of high. TCA, though, I wouldn't. I don't think so. The Russell of the group. Well, where's the big chart? Let's see the big chart. What happened? That's weird. All right. Of the group, the Russell is not at the high. Who's the highest? The S&P is the highest. That's why I picked the S&Ps today. I'm sorry, I picked the NASDAQ today. I'm sorry. I picked the NASDAQ because the NASDAQs are getting up to a good resistance point. But the Russell is below the high. The S&P is coming back very close to the high today. And I want to short whoever's the most overextended. Also, the Russell has been much higher. So I don't like, as a primary hedge, I like the S&P. And as a secondary hedge, I like the SQQs. We already have the S&P. We added SQQ today because the NASDAQ really punched up a lot. And I just think there's going to be a technical rejection at least up here, and we'll come back and test this line. So we'll see what happens. And again, like I said, there's a lot of overpriced stocks in the NASDAQ. Also, don't forget a strong dollar, which we're expecting a stronger dollar, is very good for the local currency, for American companies. It's bad for the overseas companies, the S&P, where they get half their income from overseas. It's good for the Russell, which is more, they get probably 70% of their business comes from the United States. All right. Oh, Nikkei's going all the way back up. What a shame. No, it's not. Well, that was old news. But anyway, so you see the point on the Nikkei. I don't care what it was doing because I'm watching the dollar. My primary push on the Nikkei is the dollar, and also the same with the Dow. It wasn't breaking over 1850, so I stick with it. Although now, I mean, frankly, after giving me trouble, I should really take one off the table, right? Since it gave me trouble, I could lock in a gain here. I'm short, so I have to buy, right? So let's say we come down here. Oh, I would have done that. Come on, don't be mean. Yeah. Come on, one more down. No. See that 40 stay steady, the 18 stay steady. 8, come on. 5, yeah. Lower, lower, lower. Chewing them up. Dollar's still going down. Here we go. One more. Come on, punch it, Maverick. Oh, I think they're filling. Let me put mine in the queue. Oh, what happened? Oh, there it is, yeah. That's weird. I thought it should show up there. So I've got my selling here at 55, basically. It's not hitting it yet. So if I sell one at 55, then I'm going to lock in that profit, and then I can have a stop back at my original entry at 17, and I'm still going to make $200. So I'm only risking $200, even if it goes all the way back to 17, and hopefully it'll go lower from there. So we'll see what happens. Now the Dow's behaving itself, and it's up $50. That's good. But, you know, as I said, I think the whole market's toppy. Here comes natural gas. I'm going to get another chance to play that one, too. But again, always, if you're playing, you've got to have your premise, and you've got to watch your premise. And my premise here was the dollar would be weaker. And if the dollar was weaker, then my effect on the Nikkei was almost a certainty. So I got the dollar weaker, and the Nikkei goes down, and I also know that the Nikkei doesn't recognize, it trails the dollar. See how far the dollar's gone down from the high, from 6 down to 34? But the Nikkei hasn't dropped that much yet. Oh yeah, I got my fill, see? All right, so it filled that. So now I'm down to 1, and I'm going to let that ride. I'm just going to keep dropping my stop to follow. And so now let's say I put a stop at 75. And then when if it drops down to 40, I'll set my stop at 50. And I'll just keep following down with the stop. So I lock in my maximum gains. And now the Dow's behaving itself, so I'm happy. So now I still have 2 contracts short, which I'm fine with. All right. Good. Okay, great. All right, so that's it for that, I think. We're done here. Next week, we got to go over the portfolios. But as a quick review, we got as we said, the short term's up 400%-ish. The long-term portfolio, $93.3. That's very, very nice. And the options opportunity portfolio, which used to be called the 5% portfolio, 49.5. Holy crap! What the hell happened? Wow! Whoa! It was like under 45 this morning. Wow! 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 Nothing's jumping out at me, but something moved a lot. All right. Anyway. So that's good. And then the butterfly portfolio. Whoa, that's also really good. Wow. Okay. If I had to guess, I'd have to say that the options have repriced favorably. Basically, that we sell a lot of premium, so the long-term VIX might have calmed down or something like that. It doesn't mean the VIX itself calms down, but just the long-term adjustment was made to options pricing. But somehow we had a very favorable move. Don't forget, we sell premium. Being the house things, we've always got premium that we sold. So if the value of the options contracts, there's a good chance we're going to make money on that. So and again, you can't go by intraday stuff. So I'm not going to say, I'm a genius because it went up 5% or whatever. But it's nice. It's a nice lucky break. But also, again, it goes back to what I was saying before. If you make too much money, which frankly in the 5% portfolio, in the options opportunity portfolio, making 5% a day is too much money. I really need to look at this a little more carefully and figure out, should we take something off the table? That's a lot of money in a little portfolio to make in one day. All right, so we'll tune in next week, and we'll probably, but before then, well, no, actually, next week, it's already going to be like tomorrow, then there's a holiday, and then we're into next week already. So it's not going to be long before we do this again. So maybe we'll wait. Maybe I won't touch it. We'll see. I do have to look it over, though. I can't not look it over. I got to figure out what happened. Anyway, all right, guys, so we'll tune in again next week and do it again. All right, thanks for everybody for coming. Have a good day. What was the half cover on Apple again? Sorry, that was the 67.50, the July 97.50 calls that were like $4 or something like that. We sold 5 of those because I'd rather be safe than sorry. I think we're going to have a correction. All right. Thank you, guys. Have a good weekend. Have a great holiday.